Hi, let's look into the capital structure theory and policy. As you all know that there are different methods of financing adopted by the companies. The first one is known as debt, which is known as outsiders fund. Second one is equity, which is known as insiders fund. So the composition of debt and equity mix has some influence on the value of the firm. This is one opinion. Second opinion is the composition of debt and equity mix does not have any influence on the value of the firm. So there are two opinions exist in the financial market. So based on these two opinions, the theories are formed. Capital structure theories are of different types. The first one is known as net operating income approach. Second one is traditional approach and net income approach. And third one is Modi-Miller hypothesis with and without corporate tax. These are the three important theories exist in the financial market. Let's look into the first approach, that's net income approach. According to this approach, cost of debt and cost of equity are independent of the capital structure. I will repeat once again. Cost of debt and cost of equity are independent. What does it mean? If there is any increase in the cost of debt, it does not have any influence on the cost of equity. Just like that, whatever changes that you made in the cost of equity does not have any influence on cost of debt. It is independent. So before we discuss about these theories, you should know what is cost of debt and cost of equity. Cost of debt is known as the minimum rate of return expected by the debenture holders from the firm. That is known as cost of debt. What is cost of equity? The minimum rate of return expected by the equity shareholders from the firm for supplying the funds. That is known as cost of equity. And what is weighted average cost of capital? Weighted average cost of capital is known as the minimum rate of return expected by the company from all projects and assets for giving the compensation to the suppliers of funds such as debenture holders, equity shareholders, banks, or any other suppliers. That's known as weighted average cost of capital. So you should know what are the basics of these things. Then only you will understand what is this theory. So the cost of debt and cost of equity are independent according to this approach. So as a result, what happens to the overall cost of capital? Overall cost of capital will decline and the firm value will increase according to the increase in the debt usage. Let's look into this picture. You will understand that when the debt is increasing, what happens to this line? This is known as weighted average cost of capital. Weighted average cost of capital is falling down. According to the increase in the debt, this WACC will fall down and reaches at a bottom level. If it reaches at a bottom level, what happens to the value of the firm? Value of the firm will increase. That's the opinion of this theory. And this theory tells that the optimum capital structure, the best capital structure is known as 100% debt. The firm is using 10 lakh rupees capital and the entire 10 lakh rupees used with outsiders fund. Then what happens to the WACC? WACC will reduce to a very low level, which will maximize the value of the firm. That's the opinion of net income approach theorist. Second theory is known as net operating income approach, NOI approach. This theory tells that value of the firm and weighted average cost of capital are independent. I will repeat. Value of the firm and weighted average cost of capital are independent. That's a belief of NOI approach. So this theory tells that the taxes are not relevant. That means there is no presence of tax, which is taxes are not there. In simple words, an individual holding all debt and equity securities, the tax amount will be different. The interest on tax is a tax deductible expense, but dividend tax amount is higher than the interest tax amount, as you all know that. But this theory tells that in the absence of taxes, individual holding all debt and equity securities will get the same cash flows, regardless of the capital structure. So the value of the company will remain same. So there is no big difference in it. Cost of debt And cost of equity, cost of debt and cost of equity is not very relevant here. It is very important that the value of the firm or weighted average cost of capital, it will never change. WACC will never change. Just look into this picture. It is almost constant, whatever be the debt and equity using. So this WACC remains same. That's the net operating income approach. The reason is very simple. The cash flows received by the equity shareholders and debenture holders are same. That is why the value of the firm is remaining same. And the next is known as traditional approach. This approach tells that if you are using the debt, then it will reduce the overall cost of capital. But after a certain stage, what happens to the overall cost of capital? It will increase. Let's look into this. Increase in the debt, that reduce the WACC. This is WACC line, that is reducing the WACC. But after a certain stage, you know that the risk taken by the shareholders, owners of the firm is increasing according to the usage of debt. There is a lot of risk actually involving in using the debt. The commitment to repay the interest is more. So according to this risk pattern, what happens to the cost of equity? Cost of equity will increase. At the same time, the weighted average cost of capital will also increase. So what happens to the value of the firm finally? Because the value of the firm will definitely fall down because of the increase in the WACC due to the usage of excessive debt in the capital structure. That's the opinion of traditional approach. So look into that picture again. Once again, I will repeat this. If you are using debt after a certain stage, you can see the difference. Up to that, you know what happens to the WACC? WACC is decreasing. But again, the company is using debt. Then what happens to the WACC? WACC is increasing. So finally, the value of the firm will fall down. Okay, the WACC is increasing, value of the firm will fall down. That's the theory. Okay. Then last one is Modi-Miller approach. This theory tells that firm's value is independent of the capital structure. Why? The personal leverage is always there. Shareholders can receive exactly the same return with same risk from a levered firm and unlevered firm. That's a peculiarity of hypothesis. So the shareholders can sell the shares of overvalued firms and buy the shares of undervalued firm until the two values equates. So it's known as arbitrage. A lot of arbitrages are available in the market. They will buy and sell the shares. So finally, the value of the firm will equates. Both of these value of the firms will equate just because of these arbitrage opportunities. So hypothesis tells that firm's value is independent of the capital structure just because of arbitrage opportunity available for the shareholders in the market. That's the last theory. So all these theories are actually very relevant or not. You want to check and verify that. So all these theories are working out based on certain assumptions. So study the theories. These theories does not have more relevance. That's my opinion. Thank you.